Marc, let's start from an easy question. You should be well trained to answer to this question. What are your expectations on the equity markets in Europe, and what do you expect for earnings on the companies that you are that are currently in your holdings?
Okay, so if we start with early 2017 and look at the scenario there, so it's a peculiar set of circumstance. When we did company meetings, we travel around Europe seeing companies in France, Germany, everywhere. When we met these companies, the earnings expectations that we forecast from the company meeting were ahead of the consensus analyst forecasts. And the reason for that was because, one, the Eurozone was starting to accelerate, and also other parts of the world were improving in terms of growth. Now, the critical point is the shape of consensus expectations. So at the start of each year, analysts who follow companies and general commentators who follow the market will forecast the earnings growth of a region. Start of 2014, Deutsche Bank strategists will say European earnings growth 10 to 12%. Companies who follow Siemens will say earnings growth of Siemens 15% this year. Each year from 2013 onwards, the forecasts at the start of the year were subsequently disappointed. So 2013 forecast good growth, disappointed later on. Same 14, same 15, same 16. So when you get to 2017, consensus has been disappointed so many times that it's cautious. And this creates potential for surprise, and that's critical. So at a fundamental level, the companies were showing real improvement, but the consensus, which was still remembering the past, was cautious. So during 2017, there was a good path of surprise in terms of strength of economic results and also earnings data. So, for instance, in France, when we saw companies there, the construction market was clearly improving. Housing starts, after a very weak period, were rising. Renovation demand was looking good. All of these things point towards good growth. So that, together with the low interest rate environment, provided a good backdrop in terms of earnings growth from the companies and low interest rates and lots of surprise. So that's a positive backdrop. Going into 2018, we think the trade-off between growth and inflation is not as positive. So if we look at this chart, obviously there's expansion going on globally, and the companies are reporting good results. And that means that for 2018, the reality will probably be another good year of earnings growth. However, consensus has now been upgrading for the past 4 quarters, and so has caught up with reality. No difference between the consensus forecast and the real economy. In fact, if we examine the set of results which have come out of Europe over the past few weeks, we find that 2017 earnings have been on track with the forecasts, and then the companies have given guidance for further growth, but in some cases there's been disappointment because the guidance doesn't meet the now more optimistic expectations. That's one point. So in terms of consensus expectations, they're in line with reality now, while they weren't 12 months ago. From meeting lots of companies, we find that there's tightness in lots of labor markets. So meeting German industrials, automotive suppliers, semiconductor companies, they all say the same thing. Tightness in terms of availability of software engineers, specialist technology workers, all of these areas, labor market's tight. So a bit of upward pressure in terms of inflation. So the US long bond yield moving up obviously characterized the end of the upward trend. And we now think that with a little bit more inflation and the earnings growth being reasonably well understood, the trade-off now is not as good as it was last year. And also in terms of valuations, while valuations are not stretched, they're no longer cheap either, they're more reasonable. So the combination of all of those characteristics would make us rather cautious on the direction of European equities for 2018.
And what are the risks that you foresee for 2018 for the equity markets and specifically for your fund?
The major risk, I think, is just in terms of the path of consensus earnings. So at the moment, There's no real macro risk, which the market's concerned about. So China's growing well, US is still going, Eurozone's accelerated. Chinese construction could turn down, could be issues in terms of Turkish debt. Various macro geopolitical factors could appear. The one I focus more on is the consensus path and how that looks compared to the feedback we're getting from the companies. Now, from our perspective, we try to find companies who are somewhat resilient to this trend. Every company is affected by its environment to some extent, but some more than others. So in certain cases, there's companies who have a specific product which is entering a new market or are going through a clear restructuring case or are geographically expanding and can save their customers in terms of return. And for those reasons, we expect their growth to be more resilient than the overall economy's growth. And so we're focused on long ideas which can show those defensive characteristics and are short of names where we think they've been having a good tailwind from the improvements in the economy and where they have improved their returns and earnings, but that may now be at a peak level. So the automotive industry has obviously been through a good trend in terms of volumes. Automotive suppliers are a geared play on automotive industry. They've seen margins expand and have generally seen a positive environment across their areas. We think earnings may be at a peak in some of these areas. So we'd point to automotive suppliers, commodities and commodity suppliers, and some selective industrials where conditions are now at a peak level, perhaps.
How about the risk return that you got with your fund in 2017? And can you explain the performance contributions of the fund?
So the fund, as you know, is generally driven by specific stock picking. So individual names which we think are going to perform for specific reasons rather than any theme. So there's no theme at work. And also the net exposure is usually low. So directionality didn't really help. So it's more about the performance of individual companies. So just to highlight some of those. So Cambion, which is a UK healthcare company, performed well last year for very specific reasons. It owns mental health care facilities throughout the UK. It overexpanded in 2015 and strained its balance sheet. It then had to dispose of half of its business, which was the adult care, and focus on the children's mental health care. Now, this is a growing market throughout the world in terms of provision of mental facilities. They have a leading edge in terms of a protocol which helps patients readjust. So they're very highly rated by local authorities. But the company itself, for a short amount of time, had too much leverage and too much debt. So we entered it when the risk was at its highest point, when the market was concerned about an equity issue or maybe solvency, these points. And then gradually they've improved the utilization of their facilities by focusing on what the local authorities want and taking in patients at a gradual rate and making sure the quality of care is very good. So they've gradually improved utilization of facilities and therefore improved the profitability. And that's led to a strong improvement in the valuation of the company as well. So that would have performed whatever the market environment. It's not a hostage to the overall economic circumstance. It's more just an individual case. Entertainment One is something similar. It's a media company listed in the UK, focused on children's toys and cartoons. And basically, it's got a strong expansion plan for the US and China. So Peppa Pig, which is one of its main franchises, has a large amount of growth potential outside of its core markets. It's targeting children between 0 and 5 years old. It's got a very good heritage in terms of brand. It's watched a lot on YouTube by children. And gradually, the merchandising is spreading out to US through Walmart and also to China through distributors there. This is creating a very dynamic growth path for the company. And this is the key value part of it. And so that expansion potential has driven a strong re-rating of the business over time. And then Eurofins Scientific is a company I've mentioned before, which is a leader in testing of food and pharmaceutical ingredients on behalf of food and pharma companies. Food companies around the world are concerned about the integrity of their brand when they're selling to Western markets. Eurofins tests the supply chain. It tests for toxic levels in various ingredients to make sure that there's not going to be a scare when something gets contaminated. And gradually, the food manufacturers have been outsourcing to Eurofins this test. And that's led to a strong growth of 5% organically over the past 10 years. They've also grown acquisitively, acquiring about another 5% of revenue through time, so making a revenue growth of around 10%. Now, this company is a good example of what I mean about expectations in the market. So we were long of it for about 3 years based on these dynamics. 2 years ago, there was concerns around the profitability of new labs. They were depressed, and the market was concerned about whether they'd ever recover. Also, the acquisition quality was also under question. Gradually, through time, the market has brushed off all of these concerns. And so the stock has not only risen with its earnings, it's also re-rated. So at the start of 2018, we've gone short of this company because we now think the valuation doesn't reflect any risk. The valuation was on a PE of 40 times. The long-term targets are already integrated into consensus earnings. Both the organic growth and the acquisitions are already forecast in the consensus. So we don't see upside to the consensus. And there's also some early news flow about potential pricing pressure in some of their outsourced contracts. So for that reason, that's a prime example of what's gone on in the actual market. It was a long for quite a while. We now believe it to be more of a short candidate, risk-reward skewed to the downside.
Interesting picks. The starting of the year 2018 was quite a challenging one. And how did you handle the market pullback?
So going into the start of this year, we essentially had a defensive stance. So we had a gross exposure of approximately 120%, and a net exposure of approximately plus 20, then beta adjusted more like neutral. And we were struggling to find any good long ideas during the start of the year because of the points I've mentioned about the consensus earnings and the valuation. So also we were long of puts on the market and had index futures short and stock-specific shorts as well. So going to the period of volatility, when that happened, we were actually relatively positioned in a defensive way to cope with that increase in volatility and the drawdown in the market. Now, going forward, our response to that is to increase our gross exposure and to reinforce the long bets where we have a high conviction. So normally, during a sell-off, things go down together. Longs and the shorts both go down. The NAV is left around about the same because one matches off with the other. But if we believe in the strength of the long ideas and the upside from a micro stock-specific area, then we'll reinforce the long bets and magnify the potential alpha going forward. So our response to the drawdown in the market was to increase the gross from 120 to 150, but leave the net exposure almost neutral because from a directional perspective, we're cautious. But from a stocks perspective, we obviously think we have some very strong long ideas, which we take the opportunity to add to into the weakness.
And what are the main sources of performance that you expect this year?
Essentially, the long book is positioned in quite a defensive way. So the main overweight from a sector point of view is healthcare. But that's not because of a sectoral stance. It's because of individual names that we found there. But one name I'd highlight is AMS, which obviously performed well last year. So if you look at the chart of it, you might be put off. There's no reason why it can't keep on performing on a multi-year basis. Essentially, it makes analog semiconductors, and it's a market leader in sensors and sensor technology. The first marketplace for sensors is consumer, so smartphones. The second marketplaces will be industrial and healthcare, and eventually everything. So the marketplace they're addressing is $17 billion, very closely associated with Apple at the moment. And even if smartphone volumes don't grow, the spend per device on all of AMS's technology will grow on a multifold basis over the next 5 years. All the new innovations that Apple want to introduce to make people replace their phones will require more of their technology. So the augmented reality trend, which will be in the next phone or the phone after, will require 5 times as many sensors as the current phone. In addition, in the industrial segment, sensor technology is penetrating through a large amount of the companies there. And in healthcare, it's accelerating there as well. So we think the growth rate, which is strong at the moment, will be maintained and maybe even accelerate for the next 3 to 4 years, which will mean the company can grow to 2.5 or 3 billion euros of revenue with a 30% margin. So it recovered last year based on the fact that 2016 was weak for the company. So last year was a recovery of valuation and of earnings. Now the valuation is more reasonable, but the earnings growth is very dynamic. So we're looking for companies such as that who will basically benefit from all the trends that are going on and which can perhaps see accelerated growth, even if the overall environment for the industrial activity and smartphones is more stable. Other long ideas follow similar themes in terms of either growth acceleration or accessing a structural market trend which will only accelerate. So another one I'd point to would be Sophos in the UK, which is a leader in cybersecurity. So it performed well last year, and we sold it, and then it corrected at the start of this year based on a slightly slower growth in the fourth quarter, and we rebought it. And essentially, they're a leader in providing security for small and mid-sized companies in the US and UK. They have a key product called Sophos Connect, which basically integrates all of the cybersecurity you need in one place. They then host it for the client, which means that the client needs to put in less time in terms of maintenance of all of this security. Obviously, the area has become hot itself because of the cyber attacks last year, but that isn't the reason why we like it. It's because we think organic growth will stay between 15 and 20% for 3 years, and they reinvest in the cash flow well, and we think that they're a leader in a space which will continue to strengthen.
Thanks, Marc, for sharing with us your highest convictions for 2018. We have an additional question coming from one of our guests. He is interested in knowing your take on the energy sector that you mentioned in your first slide, the first slide that you showed.
Essentially, we don't have large macro views on variables like the oil price. So we don't have an overall perspective on where the oil price is going to go to $70 or back down to 40. Now, in terms of technological change in the energy sector, that's what we look at. So we look at some companies around the sector providing services, so oil service companies who are benefiting from changes in deep water drilling, or who basically provide alternative energy solutions, are companies we look for. But on the broader aggregate sector, we wouldn't have a strong view on the direction of that.